Today's episode is brought to you by bit.com. You'll be hearing more about them later on in today's interview, which begins right now. We have a special treat today for viewers of Forward Guidance. We've got two guests who know a lot about macro. Juliette Declercq, founder of JDI Research, and Darius Dale, founder of 42 Macro. So glad to have you here, both of you here. I mean, there's just so much going on. We're recording this on the first day of the Fed's FOMC meeting. The announcement will be made tomorrow on June 15th. We're recording on June 14th. Risk assets have had a very rough couple of days. In particular, crypto and bonds, gold, typical safe haven bids have been no help at all. We have so much to talk about. But Juliette, how about I just ask you, because a few minutes ago you said now is one of the most confusing times in macro. What did you mean by that? Why? What are some things that normally hold true in macro that are no longer true? And sort of why is this a confusing period?
I'll say probably the one thing that probably confuses the most is where the economy correlates with the stock markets. And I think the same way, we've had the biggest rally of all time in the middle of the worst recession in 2020. What's really interesting today is really the fact that the worst danger, at least at the moment, for stocks and for risk in general, is actually the strength of the US economy. So I'm hearing a lot of macro pundits, the narrative around, their view on risk assets being net negative because we're headed to recession. Well, the one thing about recession is we're always headed to recession. It's like this thing, taxes or death. You're always headed to recession. But my view here is that recession is not the problem. The real problem is the strength of US demand and the strength of the US economy.
Yeah, Darius, could you elaborate on that idea a lot? Because I know in your models, you have grids where, let's say, growth and inflation are slowing at the same time. That's very bad for the economy, likely a recession. That historically has been bad for risk assets. But I think what Juliette is saying is the economic news can be so bad that the central banks will just inject tons of liquidity, and that will actually be very good for risk assets. Likewise, the threat now, if I understand Juliette correctly, is that if the economy is strong, then the Federal Reserve will have no reason whatsoever to pivot as it attempts to moderate inflation. And sort of the worst situation for risk assets is a good economy. What do you think about that?
Yeah, I don't know that the worst situation for risk assets is a good economy. It's just that the lagging strength of the economy, particularly in the labor market, is causing the Fed all sorts of trouble and heartache, because that's clearly what they're trying to slow with the tightening of monetary policy. And unfortunately for asset markets, the resiliency of the labor market, and we could start spouting off statistics, is a real big problem. As we all know, I mean, you pull up a chart of the S&P and the Fed balance sheet, or global equity market capitalization relative to the global central bank balance sheet, and those things are very, very highly correlated, above 90% on both of those metrics since 2009. So, as much as we like to think that credit and equity markets reflect the buoyancy of the economy, the real driver, at least over the last sort of 10 to 12 years, has been the liquidity cycle. And right now we're in a very deep negative liquidity cycle downturn that only stands to get worse. We haven't even seen the worst of it yet. In terms of our calculations, we sort of add up the expected change in the Fed's balance sheet based on the projected quantitative tightening program, as well as the likely change in the reverse repo facility, just as a function of reverse repo rates continuing to get hiked and remain elevated relative to market pricing. We're talking about a potential $900+ billion reduction in liquidity provision that by the end of this year. So they're trying to get rid of more cash from the system than that they removed all throughout the 2017 to 2019 quantitative tightening program that spanned 21 months. They're trying to do more of that in 7 months. And to me, it's just that is the issue.
Yeah, Juliette, it is alarming how much sell-off we've seen in risk assets. And the tightening, we're only in the first inning of the tightening. We've only just begun quantitative tightening. We've only just begun hiking rates. How much tightening do you think the central banks can do? Not just the Fed, but also the ECB and other central banks?
I mean, I think what Darius touched about is the lag between demand and inflation, which can be up to like 18 months. So, the inflation that we saw last month and the shocking number from last Friday is really a result still of like a demand strengths that generate from like 2020, 2021. Now there's a lot of narrative that inflation is it will eventually kill demand, and a lot of talk about demand destruction. What I'm saying is at the moment is really none of that. There's been no demand destruction, and in fact, if you look at what happened in the last New York Fed survey, purchasing plans are actually making like new highs. The last number was like 9%. And it's actually following short-term inflation expectations. So inflation expectations moved up to like, I think, 6% in the next year. Purchasing plans are literally blowing up. And the reason, as Darius was saying, is that the labor market is so strong. And it's particularly strong at the bottom end of the income spectrum. And for me, that's really the key thing, because it's like a complete paradigm shift that we haven't seen in 40 years. And there's a chart that I sent you yesterday, which is actually coming from last week Michigan survey, which is actually showing that lower income, so the 33% bottom income, are actually expecting their real wage to actually go up. At the same time, the top 33% income earners are actually continuing to like get more depressed and expect their real income to come down. But the point here is that for the first time in 40 years, there's a higher percentage of lower income expecting their real wages to go up versus higher income. So that's a complete change in inequalities, which in my view is actually part of the reason why the Yellen's hyper stimulus was so strong, and perhaps it's actually a feature of the plan rather than a mistake itself. But the point here is when you get much more optimism at the bottom end and much more willingness to get ahead of inflation, and that's certainly something we've seen with credit literally blowing off, and there hasn't been a letdown there really. At the bottom end, you see people wanting to get ahead of inflation and really continue to subsidize inflation with credit because of their belief that the labor market is so strong. And the problem here, with lower inequalities, is you obviously get money where there's much higher propensity to consume at the bottom end, and that means by definition almost that you get much higher goods inflation and much lower asset inflation. So to come back to your question about where we are in terms of like the sell-off in the US stock market and SPX in particular, I've actually, my last report was about showing that the only repricing we've seen so far is just in line with higher real yields. In other words, all we've done literally is pricing out financial repression, potentially on the back of like lower inequalities. So lower inequalities means less financial repression. You get stronger demand, stronger inflation, and by design, weaker stocks, weaker prices on the back of lower multiples. Obviously, the problem is that we haven't priced any chance of a recession yet, or at least a severe slowdown. And that's actually at the time where I'm also showing that finally real yields are now substantially positive. And I actually believe when looking at different metrics, including medium-term inflation, cyclicals versus defensive, or even like copper-gold ratio, you can see that we're already in restrictive territory in terms of like the medium-term outlook, which means that at some point, but because of the lag between where rates are going and the way it will hit demand, it's sort of like a drip until basically, I don't know if it was Mark Twain saying like, you go bankrupt slowly and gradually and then very quickly. And I think that really what will happen at some point in the next 6 to 9 months. What looks like a Fed which is far behind the curve, and I agree, it certainly is going to end up massively on the hawkish side. And the more you're trying to hit with higher rates today and potentially with a rate shock tomorrow, responding to like a 18 months old data, which we got last week, and the more likely you are to basically overshoot. And the more likely you're going to end up with a hard landing because you won't be able to U-turn fast enough.
I happen to think that we're very likely to get something that looks like a hard landing, and here's why. I think the Fed does a poor job of communicating just how little they understand where the neutral rate is. It's obviously a theoretical construct that cannot be observed. And so the reality is every time we go forward in time and we have an economic cycle, particularly an economic cycle as weird as this one has been, right? We're way above trend from a goods demand perspective, way below trend from a services demand perspective. And so that means from a supply perspective, the economy is just running all off kilter. We don't have enough stuff to buy and we're not demanding enough services. And so the sort of reshaping of the economy, maybe it raises the neutral rate, maybe it lowers the neutral rate, but it's very likely that the Fed has to tighten until they see things start to break, more things start to break. Obviously, we got the break in asset markets, and same deal with credit yields. If you look at the Bloomberg Barclays yield to worst, the aggregate yield to worst for overall credit market, we're at a 3 sigma move on a trailing 3-year basis. And obviously, we've always seen a significant slowdown in growth. Same deal with mortgage rates, 3 sigma move, always see a significant slowdown in growth. So the Fed has done enough from a forward guidance perspective, and shout to you, Jack. you picked the best name for a podcast quite possibly ever at the right time. From a forward guidance perspective, the Fed has already tightened us into a significant slowdown. We could see that reflected in our market-based economy and interest rates that support our market-based economy, and they're going to keep going. And so they're likely going to finally back off once the economy, finally backs off in a material way. But by then it'll be too late, right? You're going to have accumulated a lot more slowing and a lot more sort of pain. And this is why the Fed has always had such a poor track record of engineering soft landings. And last thing I will say is, why in the heck would it be an expectation that we can somehow engineer a soft landing when the starting point for the federal funds or for the unemployment rate, once the Fed began this tightening cycle, had a 3 handle on it? I mean, that's in the 0th percentile of all time unemployment rates. It has nowhere to go but up. And so to me, I think this expectation that, soft landing, softish landing, hard landing, I think the debate is moot in my opinion. We're very likely to see a significant slowdown in growth. Could we get into a recession? Yeah, maybe. We're certainly seeing recessionary signs. If you look at, consumer savings rates, if you look at, some of the sort of more material slowdown in income growth. If you look at the rise in revolving credit use, we typically see a significant increase in the growth rate of revolving credit card debt into recession, which obviously means that consumers are stretched thin from a budget perspective. And so it's our view, again, that growth is going to slow significantly. Whether or not we get a recession is a moot point. I think the answer is the economy is going to get a lot weaker.
Just to add something on that, I think for me, and it was really the metric that gave it away in '99. I think for me, it's really the U.S. credit impulse, which will feed into weaker demand from now. As you said, clearly, real income is already negative. But if you're adding the sort of like employment growth as well, which is not negative yet. I mean, it continues to add up to aggregate demand, but at some point, obviously, we will get to zero, and the only driver of demand will be basically real wages. If you take away the credit side at that point, that's basically when we get to recession in a matter of 3 months. But I just want to emphasize that credit impulse is still basically near the highs of the past 3 cycles. Obviously, it can go down really quickly, but that's something that you can compute yourself with Fed data on a weekly basis. And for me, it's really the one thing that will give it away in terms of a Fed U-turn. And there is nothing like that yet. So yes, of course, we will. The other thing on the US side is that I think there was a way to sort of like engineer a soft landing. And the way would be to actually acknowledge that today's inflation is, pardon my French, a fuck up of last year, and that you can't basically do anything about this year inflation data. So I do agree that there is an element of credibility there as well, especially when you're seeing, Michigan sort of like long-term inflation expectation continuing higher. So there is a need for a bit of a shock there. But I think it would be a lot better in terms of communication to acknowledge the screw up and the fact that the Fed cannot do anything about next month's inflation and can pretty much do nothing about end of year inflation, because there is firstly a lag between FCI and demand, and then a massive lag between demand and inflation, which means the whole process is basically 18 months. Which kind of like make me smile, suddenly looking at adding another 75 basis points per meeting in the next 2 months, just responding to last week's data. So for me, there was a way of sort of like engineering a soft landing, and I'm still not too worried about an entrenched recession because I do see inflation coming down next year. But obviously, there is an overlap where you're going to get it's going to be very difficult to get an improvement in the growth policy trade-off by the end of the year. And that's why I'm still very negative on risk assets and very positive the dollar as well, because I think as inflation comes down, real yields will continue to move higher.
Yeah, and one thing I'll add to that, it's saying that I think at this point, the sooner we get into recession, the more likely it is we get a rebound in asset prices. And as perverse as that sounds, it means the Fed can take its foot off the brake in terms of slamming down the growth rates of the overall economy. I mean, I think the Fed has done a decent enough job pivoting from their sort of, prior set of expectations around what's causing inflation, what's driving inflation, to acknowledging that inflation is a residual of supply and demand. It's met at the intersection of supply and demand. If you know you've had an inward shift on the semi curve, you got to do something about demand. You can't just sit there and throw your hands up. I mean, guess what? We had all kinds of supply chain problems in the 1970s, oil embargoes. You had all sorts of different policies in the labor market that made a lot more friction in the labor market, a lot higher wages. And then you had this, for lack of a better word, bozo Arthur Burns at the top of the Fed, constantly easing monetary policy, expanding the Fed's balance sheet, keeping the interest rates below the neutral level. I'm not sure if they understood that concept back then, but it obviously took a Paul Volcker to come in and clean up that mess. And so I think this Jay Powell himself as a human being understands that he got this call wrong. He understands that his colleagues got this call wrong, and they have to do something not only to deal with inflation, but to protect the Fed's credibility, protect his legacy, protect the institution from who knows what could happen if the inflation genie is persistent and stays out of the bottle for much longer than kind of the consumer would be comfortable with. I appreciate your optimism, Juliette. You somehow found like the only positive dynamic in that University of Michigan confidence survey, because when I read that survey, it looks like a consumer that's certainly about to slow down pretty significantly as a function of this rising inflation expectations. I mean, when you see an all-time low from an index perspective, that's worrisome. I mean, because I would have assumed that conditions were worse in the 1970s. We had 3 recessions and pretty sluggish real economic output.
But if you looked at that number, you would have called a recession 6 months ago. And so I think there's definitely an element of what really matters is the fact that inflation is extremely stimulatory. And what I mean by that is, there's 3 ways inflation is stimulatory. It's firstly, inventories. When you've got inventories and there's inflation, you're laughing, prices go up, you can pile up as much as you want. The second thing is when there's inflation, the labor market is a lot stronger. And the reason is that, when you've got inflation, all you have to do to sort of get your, in a downturn, you don't actually have to sack people. All you have to do is basically to freeze salaries. And if you've got 10% inflation, you basically got your salary base down all in one go. And the third thing is obviously the one thing that we discussed before is the one rational way to fight inflation as an individual is basically to borrow and front load your consumption. And that's what we've seen. And that's why the Michigan survey is just completely misinterpreted in my view. And the focus should really be on the strengths of the labor market. Because as long as you've got the strengths of the labor market, you've got enough optimism, enough animal spirit in yourself to be like, you know what, if that's going to be 20% more expensive next year, then I might as well borrow at like whatever. That's really the one thing that the Fed has not managed to break yet. And that's sort of like, for me, the main worry in terms of how much we're going to have to overshoot to basically break that animal spirit and that like strength, which is due to the stimulative effect of inflation, which, as you said, nothing we've seen in our lives. I mean, I wasn't there in the 70s, or I was there, but I wasn't trading or analyzing anything.
Yeah, I just want to shift to talking about financial conditions. Are we anywhere close to a point at which financial conditions are sufficiently tight to even begin moderating inflation? And I'd note that so much of the tightening of financial conditions, the financial conditions, it's risk-free rates, treasury rates, equity prices, equity risk premium, credit spreads, as the dollar. So much of it has been in the dollar as well as the treasury market, which the Federal Reserve sort of, has kind of on a puppet string via forward guidance. And, I think yesterday we saw one of the biggest sell-offs in the short term of the yield curve since I think, the summer of 2009. So on the risk-free treasury rate, we're seeing a huge tightening of financial conditions. But on the equity and credit market, are we anywhere close to where we need to go for inflation to moderate, to actually have a reverse wealth effect? Darius, how about we start with you?
No, the answer is resoundingly no on that front, in our opinion. When you look at something like the Goldman Financial Conditions Index, we're still technically very narrowly in accommodative territory. I mean, this thing could shoot up another 2-3 points relative to where it's been, in particularly when it's in and around recession. And then you look at the next 12 months earning yield for the S&P, it's at 6.09% today. Could easily get over 7-8% if you're talking about pricing in something that looks like a recession. Again, if you talk about recession, I definitely agree with your point, Juliette, that the University of Michigan confidence survey is largely misinterpreted. Doesn't have a particularly high correlation to consumer spending, et cetera. I think it's just sort of a barometer of how people feel. And it really, quite frankly, it's just, it looks exactly like the president's approval rating in that regard. So there still needs to be a lot more damage done from a labor market income generation perspective. You look at aggregate income, growing at 8% on a 3-month annualized basis. That's way too high to see consumer demand buckle in a material enough way to reduce that demand curve. And so, to answer your question, Jack, no, I think financial conditions are still uncomfortably loose, which is why I believe the right thing to do is to remain bearish on risk assets. You don't need a recession to see a 30-40% drop in the S&P. If you saw a 30-40% drop in the S&P, it's likely to aid and abet causing a recession, but you definitely don't need that. There's plenty of economic history and market history of the market, selling off pretty aggressively, just on policy alone.
So on FCI, my view is that potentially we would be at levels that should bring down demand and in turn inflation. In fact, I've got a model which is just looks at demand as a result of real income and the credit impulse. So looking at everything that all the income in the economy, and what's really quite interesting, and I'll send you the chart later, and maybe you can put it on screen later, is that there's a very clear 9 months lag between where FCI versus, and I'm looking at FCI as versus last year. I believe it's the change in FCI which moves demand rather than the absolute level. But what's really clear from that chart and from other pieces of analysis is that, again, FCI today is a lot tighter and is probably tight enough to bring down demand. But the problem is it's in 9 months. And in the meantime, as you say, you do have to overshoot. So I completely agree with you that we will tighten a lot more, and we will over tighten. And for the good reason that, the tighter financial conditions actually drip into the economy until finally you get the slowdown. And that's the time where, equities are not just pricing lower financial repression, but are also starting to price, stagnation and potentially a recession. So by design, we will get a lot tighter. And it will be slow at first, and the Fed will have to push it. And at some point, the Fed won't have to push anything anymore. And it will be like sort of like end 2018, where, you get the like 20% down and the U-turn. Except this time, it's not obvious that you're going to be able to make a U-turn because, I think it's a good time to like move to the ECB. But if you're in the middle of a recession with like 10% inflation, which can easily happen because of the lag between, lower demand and lower inflation, then the question is, what do? You can't print, you can't lower rates. And so that's sort of like the third, the first two things is like double whammy, pricing first financial repression, then pricing lower earnings, and then potentially price.
Today's episode is brought to you by Bit.com, a leading cryptocurrency trading platform. From spot to futures to options trading and more, Bit.com has it all. So whether you're a seasoned investor or you're new to the game, you need to be on Bit.com. Bit.com has launched a zero taker fee option campaign until May 10th. To enroll, email VIP@bit.com. That's bit spelled B-I-T. So email VIP@bit.com and tell them I sent you.
The fact that there is nothing central banks can do. And potentially in the US, it won't be much of an issue, but it's certainly an issue that I see an acute issue in Europe, where on top of everything, the central banks, the ECB, has to deal with like fragmentation and the fact that debt to GDP ratio, which were never an issue before because you were able to, thanks to the ECB and thanks to monetization, you were able to issue debt at deeply negative real rates and certainly at levels below the level of like real GDP growth, which means that there is no risk of debt to GDP ratio spiraling. The problem is now you actually have those like sovereign spreads exploding, which means that potentially where there is the worst risk of the recession, e.g. in Italy, where there's also like the higher debt to GDP ratio, you potentially will not be able to actually resort to fiscal policy and because monetization outside of a deep crisis is actually outlawed in Europe. So I think that's really where my focus is at the moment. The Fed might be able to engineer something that doesn't look too much like an abyss, but I'm worried about what's happening in Europe, where I think that the recession is clearly already in the cards. Inflation is near 10%, mostly supply driven, and the ECB is also trying to basically avoid sovereign spreads exploding with absolutely zero tool in its hand. And the reason is that before, you were always able to, keep pumping credit by lowering real yields. And that's basically done. The end of free money. We always knew that, the MMT would basically like hit a wall when there is inflation. I think that's something that we always talked about like two years ago, like MMT is going to end when there is inflation. But there isn't much talk about it today. The fact that, potentially free money is dead and we are going to be having to deal with the cycle without the fiscal help and with very little counter-cyclical tools in hand.
So it sounds, by news accounts as well as by your own account, it sounds like Europe is in quite a quandary, the financial markets as well as the economy, as well as politically. How does that play into two of your views? Number one, which is you're quite bearish on the euro, the currency, and then also you sort of been tactically trading the European stock index from a long side. So could you just explain those two views, and then I want to get Darius's views.
Well, firstly, on equities, European equities, there is actually it's one of the stock index in the world which has a very substantial equity risk premium for good reason, and I actually think that the euro will be a much weaker euro will be an escape valve. I basically recommended, buying a very deep in European stocks, and I'm quite happy to hold it still, with sort of like a long-term view on the back of like a high dividend yields and extremely high equity risk premium, which is already pricing a severe slowdown and a recession. But at the same time, I am bearish. Sovereign bonds, peripheral bonds, and I think euro will take a huge hit, and I think it will be the only escape valve. And whatever the ECB does, hiking rates is not going to help the currency whatsoever. The US is a lot stronger, is by far the strongest economy in the world at the moment, which means that global growth will be desynchronized. That also means that into the rest of the year, FCI is going to be tightening, not so much via higher yields anymore, but potentially with a much stronger dollar and much weaker stocks. So I'm actually looking for FCI to tighten in the US via a much stronger dollar and lower stocks, with actually yields peaking, imminently.
And so just as a quick follow-up, Juliette, you're certainly a lot closer. You do have boots on the ground in Europe. I think you spend a little bit more time than I do in terms of analyzing those economic dynamics there. What do you think is most different in terms of the current setup from a labor market perspective, current setup from a growth perspective in Europe that is different than the U.S.? I would argue that with the fiscal stimulus coming down the pike in Europe, it's very likely that Europe may be able to withstand, what is very viewed by the market, a somewhat dovish ECB relative to the sort of inflation dynamics over in Europe. So I'm not saying Europe is or is not going into recession, but if you put a gun to my head, I would think just that our overheating economy over here in the U.S. risks, driving us into recession purely as a function of the Fed's reaction function to those dynamics. What are your thoughts?
So on the fiscal stimulus, the first thing is that it's a long-term stimulus, like looking for like a transition in energy is a long-term thing. But also, all those that are talking about a stimulus in Europe are not taking into account the fact that, sovereign spreads have exploded and rates have exploded. I think it was all great talking about, what I've been calling like Casa de Papel, is basically like break the bank, and Macron's whatever it costs. For me, this is gone, and whatever you spend in the future will have to be coming from somewhere, and will either blow up spreads further or basically lead to spiraling debt to GDP level. So I'm not so sure that the fiscal stimulus will be as powerful as many expect. Also, if you're looking at the French election, which is happening, the second run of the parliamentary election is this weekend, it's quite likely that Macron will have his hands tied, and that he will not get an outright majority in parliament. So you're talking about like a weakened sort of like, leader of Europe into his second mandate, which is also going to be an issue in terms of like regrouping EU countries behind a leader and being able to sort of pass the really bold measures that were passed in his first mandate.
Gotcha. That makes sense. Thank you.
Darius, I know that you've started to look at investing on the short side, so shorting equities, which is, I don't think is something that you typically do during a normal economic period. Why did you start incorporating that? And does that speak to just just your level of bearishness that you have on risk assets?
Yeah, no, we've been short for most of the year. Pick your sector, pick your market. Right now, we're broadly short U.S. indices, and do believe that, just if you look at it from a targeting perspective, we don't see reasonable fair value, and I don't mean sort of your traditional valuation, lick your finger in there, fair value model. We mean just relative to where we think the Fed might actually pause, pivot, and start supplying liquidity to the market again. We think that level's somewhere between 3,200 and 3,400 on the S&P. So that obviously means we have a decent amount more pain to go before we think financial conditions have tightened enough, and we'll have seen enough slowing in the labor market, slowing in the economy enough for the Fed to get comfortable that they're getting quote unquote, clear and convincing evidence that inflation is returning to their 2% target. So in terms of, generally speaking, just as a rule of thumb, as an investor, you generally want to be extracting risk premium from the market. You don't want to be paying risk premium to the market, which obviously occurs whenever you're short securities. So you need to be good on timing with respect to that, and you also need to be good on the catalyst. And when I look forward, the catalysts actually get worse in the coming months and quarters as opposed to getting better. So from our perspective, I think you can continue to step on the neck of the market here, quite frankly, for lack of a more rosy picture.
Juliette, you've got a chart of real yields relative to the S&P 500 earnings yield. What level of the S&P 500 earnings yield would sort of be like a real R star to truly moderate inflation? And then if you were to translate that into the price on the S&P 500, does Darius' sort of target of 3,200 to 3,400, is that within your range, or is you different?
Obviously, it will depend on earnings as well. But at the moment, that's the level that I would say starts to incorporate a high chance of a recession, and obviously, financial repression as well. So that's definitely a level where I would start to be dabbing in as well. In terms of like the charts that you refer to, I'm looking at equity risk premium versus real yields. And you can see that real yields are basically already overshooting the medium-term equity risk premium, which I see as what is priced in terms of risk to the growth outlook, to the medium-term growth outlook, and we're already overshooting to the same tune as 2018, where you got a very clear signal in 2018 that sort of like late cycle dynamic where we're in train, because anytime you get higher prices, you end up having automatically higher real yields, which means that you can't move up, and in the end you sort of get the flush that we got in at the end of 2018. So it's really quite similar markets in my view than 2018, except really for the fact that I'm not sure that the Fed will be able to U-turn when we get the next 20% downside in SPX, and at that point it will start to get a bit scary if we can actually lower real yields. So with
I think it's scary right now.
Yeah.
The scariest chart in macro, in my opinion, sitting here today, is the price chart, is a nominal price chart of the S&P 500 next 12-month earnings.
Yeah.
Still up and to the right, making new highs as of right now. I don't know how good the dope Wall Street analysts are smoking, but they need to take those numbers down, and we're not going to see a durable bottom in the stock market until those expectations come down.
Just to explain that for the audience, Darius. So that's analysts on Wall Street sort of making the numbers up, or projecting, which sometimes they are correct, but those projections for future S&P 500 earnings are still up. So when we say the earnings yield is so and so, that is incorporating those earnings. And if those earnings are wrong because growth is slowing, we have a recession, then that is something to watch out for.
100%, absolutely.
Yeah. What's really madness is how much you've basically taken down earnings globally. If you're looking at MSCI earnings year on year, and you've definitely seen like massive downgrades, and in S&P not at all. And I completely agree with you. It's just I do think that the US economy is a lot stronger, and I do think that final demand there is a lot stronger, and there's actually a structurally higher demand than pre-crisis, which explains the burst of inflation. But I still don't see how earnings make any sense here.
Yeah, I mean, just two stats I'll throw out. You look at unit labor cost inflation running at 8% year over year. That's the fastest number we've seen in 4 decades. You have non-farm productivity down 0.6% year over year. That's the lowest number we've seen in 4 decades. Those two numbers, if they stay anywhere near there, which you could argue maybe they're likely, at least on a unit labor cost perspective, are likely to continue climbing. There's no way in you know, for part of my French as well, there's no way in hell S&P earnings won't you know, flirt with something that looks like a profit recession. In fact, I think investors, you know, that's probably the next leg down if you think about it from a market perspective, which is companies having to report reality about their cost structures. Yeah. I mean, we know this at 16%, the S&P 500's operating margin is 200 basis points higher than any prior peak in history. I mean, we can have an earnings recession just to go back to the old prior peak. And obviously, if we start slowing in a material way, you know, the previous prior highs is very unlikely to be the destination. So from our perspective, I think there's a lot more sort of pain to come as it relates to surprise risk, you know, particularly on corporate profits.
I've got a question I want to ask both of you. Juliette, I'll ask you first. What do you think is the level that will be an appropriate overshoot to moderate inflation on the Fed funds rate? So I think the terminal rate implied by the forwards curve is about 3.9%. Do you think number one, do you think we'll get there? The Fed will get there. And number two, do you think that is sufficient, or the Fed will have to go even higher to overshoot and really moderate inflation, as you say?
So before we had the Russia-Ukraine war, and when global growth was more synchronized, e.g. there was this big dumping in growth in China and obviously in Europe as well. My view was that US rates needed to get above 4% before you were going to be able to slow down inflation. In the meantime, global growth has strongly desynchronized, and I now expect the strength of the dollar and much weaker stocks to actually do part of the job that rates should have been doing. So even if, you know, we are close to price 4% now in terms of terminal rate, I actually don't think that will be delivered. I think we will see a lot tighter financial conditions on the back of a stronger dollar and weaker stocks, and therefore the Fed won't be able to deliver the rates. That's my current view. Obviously, if I'm wrong on Europe and China, if I'm wrong that the dollar is about to have a massive move higher, then we can continue to push a bit higher in rates. But I hope that answers your questions.
Yeah, I mean, to be totally honest with you, I don't believe in this sort of concept of neutral rates. Not to say that the theory is invalid, but it's not something that we can observe, and so it's not like we're turning an air conditioner dial to the right setting and we're perfectly gonna tighten the economy to this perfect level that causes the markets to go down just enough for inflation to get back just under control. Like, to me, that's far too specific. The economy is this very amorphous, beast. It's hard to control. It's hard to rein in. It's hard to, do a lot of things from a policy perspective. We know when you dump a bunch of money in consumer bank accounts and balance sheets, they're going to spend it. And when you dump a bunch of money into asset markets, they're going to go up. And we effectively, so we caused a lot of inflation. Now or as a function of that, the Fed's got to tighten until it sees enough stuff broken. And whatever that level is, then we'll look back in history and say, okay, that's probably where the neutral rate was. But I mean, I think this expectation that we can, ex ante determine that is a fool's errand, for lack of a better term. I think what's really happening is there's, I forget how many members are on the FOMC. It's 12 to 15 members. They're sitting around a table going higher, higher, balance sheet lower, rates higher. And they're going to do that until they see enough damage from the economic perspective that gives them confidence again that inflation is returning to their trend. So we don't need to be specific. We just need to know things are going to get worse from a tightening perspective.
And so, given both of your macro views, how are you thinking about asset allocation, in particular a safe haven? Back in the good old days when stocks would go down, bonds would go up, maybe gold would go up as well. We are no longer living in these days. Long duration bonds have had a record sell-off alongside stocks, and that the correlation has been the opposite of what people have had to expect. So, Darius, when you're constructing a portfolio, how are you thinking about bonds and Are you looking for bond proxies now that bonds are no longer working?
No. I mean, I still think it's too early to buy bonds. The bonds are really start to work, in our opinion, once we get a little bit closer to a more significant slowdown in growth. And right now, I mean, to Juliette's point, which I agree with, our data would suggest, we're not slowing materially enough yet that I think would cause investors to start betting on an eventual Fed pivot, which is how and why bonds rally into tightening cycles. They've historically rallied into tightening cycles. The problem with this tightening cycle is that the expectation that the Fed has to take up neutral rates or take an interest rate, to a much higher level than it's taken it in recent decades and recent tightening cycles. That is what's scaring the bond market here. And so, just from an overall asset allocation perspective, at 42 Macro, we have, in terms of what we have represented in the portfolio, there's sort of four key themes that I think investors should be taking advantage of. Number one, short U.S. equities and credit. I mean, to me, that's about as no-brainer trade as there typically ever is in macro. I mean, you basically have every factor working against it from a macro perspective when you look at the growth cycle, the inflation cycle, and liquidity cycle, and by the way, the profit cycle, which is still yet a major shoe to drop. The number two theme, we continue to be long energy and agricultural commodities. I mean, there's no signs of a real material alleviation from a supply perspective on those goods. We're certainly seeing a drawdown in prices for base metals as a function of the global growth slowdown. That's a lot more receptive and responsive to those dynamics. But things like energy and ag can very much continue rising in price well into a recession if we get one. The third theme, we think the Chinese economy, to Juliette's point on desynchronized growth, China is very much likely to be on a different path from a growth perspective. We're in recession for the last couple of months in terms of the zero COVID policy, and we're not saying we have any real edge on the alleviation of zero COVID, but we certainly believe the Chinese growth cycle has inflected higher. Our data suggests that. Our grid model is projecting them to be in reflation. That's growth up, inflation up for an extended period of time. And so, having exposure to China would be the third theme. And then the last theme, I think, in anticipation of finally getting to a place in the bond market that makes sense to buy yields. And really what that means is getting to a place in the growth cycle that, makes sense for, investors to start allocating to fixed income in size. Then it's cash. Again, you have a big cash position so that when bonds do start to rally, you can allocate to that. And you still want to maintain a decent cash position. Once we get closer to what we think is the bottom of the growth cycle, you actually have money to buy stocks and crypto and everything else on the cheap. And this is the problem with most investor portfolios. They came into this year extremely long of risk assets. You look at, you take the flow of funds data and you look at the equity ownership, and this is US data, but I would imagine it probably looks very similar across the world. We hit up north of 30% in terms of the ratio between equity ownership and overall net worth. That was an all-time high heading into Q1 or Q4 or Q1 of this year. And so every single time we've seen that cycle peak, which it looks like it very clearly has, you've typically seen a decent crash in the stock market. That's the same thing with the broader business cycle, same thing with the broader valuation cycle. I mean, this is as cheap as or as expensive as the market has ever been when you take the S&P's next 12-month earnings yield and subtract CPI from it to get sort of a real valuation metric. It may be a little bit of loose accounting there, but the reality is we've only had 6 inversions in that metric going back to the early 1960s, and the median drawdown in the S&P is minus 41% from those negative prints. So this is a very overvalued market, a very overowned market, and you're not going to see investors really pile into fixed income until they can get a handle on maybe seeing a pivot, an eventual pivot out of the Federal Reserve, which will only happen with more pain and risk assets and a deeper growth slowdown.
Thanks, Darius. Juliette, the question that I asked Darius was, how are you thinking about asset allocation in general and specifically fixed income? Bonds can no longer be relied upon, or up until this year have not been able to be relied upon as a hedge because bonds have been going down alongside stocks. Do you expect that to continue? Is there any part of the yield curve, whether it's nominals or inflation protected fixed income securities that are attracted to you or no?
So in terms of asset allocation at the moment, I don't think in terms of like asset allocation. For me, it's really like a trading market, and you don't invest yet. You really trade, and I think that's quite interesting. Chinese authorities have really like spent most of last year massively tightening financial conditions, and obviously that's part of what created this recession earlier this year. But obviously the fact that first there is no inflation, and secondly that there's already been financial tightening in the pipeline means that we're in completely different monetary and liquidity cycle, which means potentially Chinese assets could be starting to be interesting in terms of longer term investment. And against those kind of like too longs, I would look to continue to sell spikes in US stocks, which are still dramatically overvalued. So that's my current framework. As long as continuing to look at explosion in sovereign spreads in Europe.
Wonderful. Thank you, Juliette. Well, thank you both for this has been a fantastic conversation. I feel like you both are cautiously bearish on the S&P 500 for slightly different reasons. Either they have to do with inflation or recession, or both of them. But yeah, I've learned a lot. I would love to have both of you. I feel like this is a great pairing. Darius and Juliette, thank you so much. Thank you everyone for watching. You definitely should check out the research services of Darius, that is 42 Macro, and of Juliette, that is JDI Research. Thank you so much, and thank you, Darius and Juliette.
Thank you, Jack.
Appreciate you, Jack. Thank you, Juliette. This was awesome. I'd love to do it again.
Yeah, I was very happy to meet you, and hopefully soon for real.
There is something that you need to be doing right now, and that is reading the Blockworks daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.